How a 401k loan can increase your net worth. I wrote about this in my first book, Strategic Money Planning, and I'll share with you now as well because this is critically important to understand. All right, so a lot of people out there never borrow against a 401k ever. No matter what you do, don't borrow against it. Bah! And those people are wrong. They don't know what they're talking about. Unfortunately, right now is not the time to borrow against a 401k, and I'll tell you the mechanics of this here in just a second. All right, but let's take an example. Let's say old Josh. I got $50,000 in debt, and I got $100,000 in my 401k fully vested. All right. So how a 401k loan works is that you can take up to $50,000 or 50% of your vested balance, whichever is least. All right. So whatever is lesser the amount. So you can borrow up to $50,000 or 50% of your vested balance. Well, in this case, I got a vested balance of $100,000, so I can borrow $50,000 because that's also half of my vested balance. All right. So we're gonna say I got a 401k loan of $50,000. So I got two Josh episodes here. I got $100,000 in my 401k fully vested, and we'll just say it's the S&P 500 with a $50,000 debt. Now, right now, I'm not even, it doesn't matter what the cost to service that debt is. We're just going to say it's the same. So bear with me. So I have a net worth of what? Well, in this case, I got a net worth of $50,000. $100,000 in assets, $50,000 liabilities, net worth of $50,000. Done and done. All right. Now, what I'm going to do, though, is I'm going to borrow $50,000, we'll say back in January, borrow $50,000 against my 401k in which to pay off that $50,000 of debt. So now I have $50,000 in my 401k and I have no debt. My net worth is what? My net worth is $50,000. And we're going to assume the cost to pay back the loan on the 401k is equal to the cost to pay the loan back when I did not borrow from my 401k. So from a cash flow, we're going to say is all even Steven. So I'm sitting at $50,000 of net worth on both sides. However, the market now takes a 50 or a 30% kaput. So now that $100,000 in my 401k is now down to $70,000. Yet I still owe $50,000. So my net worth now is $20,000 because I lost literally $30,000 because the market declined. Not good. Now, my other account, I have $50,000 and no debt. That is also down 30%. So now I'm down to $35,000 there, but again, I have no debt. So in this case, because I only had $50,000 at risk, I still have a net worth that's $15,000 ahead of the net worth when I did not borrow against my 401k. So the reason I said you don't want to do this now, a 401k loan, is because the market is too low. You should have done it when the market was high. I'm just telling you, this is what I've been saying. I must have done probably 5 videos on this. If you have debt, use a 401k loan to pay it off, man. Don't wait. Don't procrastinate. Do it. But you should never do it. Well, then in this case, you're down $15,000 because you listen to the people who don't know what they're talking about. You should have. Without question. Now, what people will say is, it's even better here too, because when you borrow, when the account is high, you are forced to dollar cost average, all right, back into the market. That's how a 401k loan works. You are forced to DCA, dollar cost average. Every month you're putting in, I don't know what it is, $1,000, $500, whatever your loan amount is, back into the market. So the money that you are putting back in is now your money, and the growth of that extra $5,000 or $1,000 that you're putting in on a regular basis is also yours as well. So now you're forcing yourself to sell high. Now, we didn't know it was high. I mean, no one knows. And on top of that, you're reinvesting when the market is low, which is exactly what you should do. Sell high, buy low. It's like the perfect, if you would have borrowed against your 401k in January, it's like the perfect storm of increasing your net worth. There's just no two ways around that. And people who argue against that are wrong. Now, what they'll say is, well, if you got laid off, yeah. If you got laid off, that stinks. You will have to pay it all back within 60 days, I believe. And if you don't, it will be taxable as ordinary income, which stinks, and you have to pay a penalty of the $50,000 or whatever the remaining loan balance. It's not the amount you borrowed; it's the remaining outstanding balance. You have to pay a premature penalty if you are under the age of 59 and a half. So again, the drawback is if you get laid off, you have to pay the whole thing back within 60 days, or else you'll be taxed as ordinary income on that distribution, and you'll have to pay a penalty if you're under the age of 59 and a half of the amount for which is still outstanding, if that makes sense. All right, so now the benefit is when you take the 401k loan, it is a tax-free event. You do not have to pay taxes on borrowing from your 401k. You don't get a tax deduction on the money going back in. The money going back into your 401k is after tax. Well, it only makes sense because the money coming out was also after tax. You don't pay tax on the money coming out. You don't pay tax or get a tax deduction on money going back in to pay it. It's a wash. Everyone gets all caught up in that. You're paying tax twice. You literally are not paying tax twice. You just are not. You're paying is coming out tax free, is going back in after tax. I don't get the whole thing where everyone says you're paying tax twice. You literally are not doing that. So what happens, the benefit of borrowing against your 401k is that you are having access to the money tax-free before you're 59 and a half. You can literally do whatever you want with it. Don't take it on vacation because you literally then lost your net worth. But you want to use it to buy an asset that you might think is not correlated to your investment. I.e., you want to put a pool in your house. You want to, buy a condo that you can rent out for Airbnb. I don't know what it is, something like that. Man, a 401k loan is wonderful to do that. You want to pay off some debt. A 401k loan is ideal to pay off debt without question. You're getting every single penny of the market, the growth of the market. You will get that for obviously the remaining amount in there, and you'll get it when you put the money back in on a dollar cost average. So every $1,500, $500, $1,000 you put back in on a monthly basis, that money is going into the market and thus will grow according to whatever the market is doing. People just don't get this. So now the reason I say don't do that now is because you're now down to $70,000. All right. So if you borrow against your 401k now, the max you can borrow is $35K here. And if you have a $50,000 debt, well, that doesn't get the job done. You needed to borrow enough to pay the entirety of your debt off. So you don't want to sell when the market is low. That doesn't make any sense. Don't do that. So don't borrow against your 401k now. But when the market comes back up, it's going to be a while. But when the market comes back up, that's a wonderful time to borrow against your 401k in which to pay off debt or to buy a different kind of asset. And again, whatever that asset is, I'll leave you to determine. But certainly, you don't want to use it to spend. Hope this helps. Love to hear your thoughts. See ya.